Good afternoon, everyone. Hadley and Connor outlined some pretty dramatic growth plans over the next 5 years, and obviously, in order to do that, they need to sort of start at a very high level, and because of the size and scale of the operation, that growth comes from a lot of different areas. So we wanted to try and bring some of this to life for you. So the next section, we're going to do a panel with some of my colleagues who are responsible for a lot of that growth, and really try and highlight 3 examples of what Hadley talked about. One, growth from our existing mature strategies. 2, growth that comes from complementary strategies that spin out of that. And 3, growth from accessing new channels for fundraising and for capital. So I'm going to be joined on stage in a minute by these 3 individuals. But first, Anuj Ranjan, who is the CEO of our private equity business, is going to come up and talk about Brookfield Capital Partners, which is our global flagship private equity fund. We've launched the 7th iteration of that fund, and it's a little unique in the private equity world. But when you hear the description of the strategy, it's really not unique to Brookfield, right? So it's very focused on durable cash flows, businesses that are complementary to what we do in infrastructure and in real estate. And as a result of that, has had a tremendous track record. So over the last 25 years, through the first 6 vintages, we have an average return of 26%, which I think is the best performing private equity track record in the market today. And a lot of that, importantly, comes from, and this will sound very, very familiar from our other businesses, from operational improvements. A huge focus on that. As Connor said, we're not really relying on markets being buoyant and multiples being high to get those returns. A lot of it is coming from just rolling up your sleeves and driving returns. Joining us as well will be from Brookfield Infrastructure Income Fund is Chloe Berry, who this is a unique fund. So this is an example of a new fundraising channel for us, this is now our largest private wealth platform. Launched just 2 years ago. We've raised over $6 billion for this strategy. Also unique compared to some of the competitive product out there in that it's not a new strategy. Really what this is it's offering the best of Brookfield Infrastructure in particular. So it co-invests alongside our global infrastructure fund, our global debt fund, BGTF, the transition fund, and our structured equity product as well. So Chloe's going to talk a little bit about what's made that successful and how what the plans are for the future. And then finally, Sikander Rashid's going to join us. Sikander runs our infrastructure business in Europe, but more importantly is responsible for launching our AI fund, which will be coming out later on this fall. For those of you that have been to this conference before, you're well familiar with the 4 Ds, one of which is digital infrastructure, which we've been investing in over the last 10 years through our infrastructure business. But because of the scale and growth and explosion in demand for this type of product over the last 12 months, we really see an opportunity to break this strategy out as a whole individual fund. Sikander's going to talk a little bit about what's driving that, but Connor touched on this as well. We think there's a $7 trillion opportunity here for the capital that's going to be required to build out data centers, additional compute capacity, and all of the associated power generation that goes with that. And so this is a great example of a complementary strategy being born out of an existing one that we already had. So without further ado, I'll ask the 3 of them to come join me on stage. So, Anuj, maybe we'll start with you. You and I always debate about whether real estate had the first fund or whether private equity was the first fund 25 years ago. But either way, we've been doing this for a really long time. You're the boss now, so you don't have to give Cyrus all the credit. But tell us, what has actually, been in your mind the key differentiator for this franchise to drive those returns?
So look, just to clarify, private equity was the first fund. Real estate can be the biggest business, but you can't take away being the first from private equity. What we do is we are value investors who drive operational transformation in the businesses that we own. We focus on industrial companies and essential services that touch the Brookfield ecosystem, where we have an information advantage, or we know the business better than anyone else could. Our goal is to be the best owner of the business, not just the highest payer of a business. we make most of our money through margin expansion, not multiple expansion. And so the goal really is in any company that we own to be able to just increase the free cash flow in a business enough that it generates our returns on its own. If we are lucky and we get some multiple expansion on exit, we do even better. All of that taken together, it's allowed us over 25 years to have a top quartile track record that has been very consistent across all of our funds. It's also allowed us to build some complementary strategies around our core flagship offering. And so this capability we have in industrials, essential services, and operations, it's allowed us to build a structured equity product. It's allowed us to build a new wealth product that we're soon to be launched, and a financial infrastructure product as well. And so I'd say we're pretty happy and pleased with how it's performed over the past 25 years, but we've really got a lot of ingredients in place today for expansion.
Yeah, so regardless of which fund was first, which we can agree to disagree, over that time, that last 25 years, we have launched a lot of different strategies, and Connor had a slide where a bunch of dots just sort of magically appeared as new strategies over that period of time. But Siko, it is a lot of work launching a new fund strategy. Maybe just talk a bit about how the AI fund came about and the process that we've got to go through to stand a new strategy up like this, even when it is complementary.
Yeah, no, Brian, happy to. Look, firstly, I'll say it's been one of the most fun projects, if not the most fun assignment I've had over the last 13 years at the firm. But obviously, it's not come without its challenges. We've had to huddle up multiple times over the last 18 months to ensure we have conviction that this is going to be a highly scalable platform, to make sure we have the right deals to show to our investors, and also, obviously, to make sure that our clients themselves are interested in a product like this. So those have been some of the challenges we've had to grapple with. The good news is we've done it before, as Hadley talked about earlier. Just 4 years ago, we launched our transition strategy, which, as Connor mentioned, today is generating $400 million of annual revenue. We've raised $30 billion of capital over the last 4 years. And at the time, I would say there's 4 important considerations. First was, is the tangible market opportunity big enough? The answer was yes. We expect tens of trillions of dollars will be invested in the world to decarbonize it. Secondly, do we have the credibility and the track record? At the time, yes, we had $100 billion of assets under management for renewable power around the world. Third was, can it be scalable? And fourth was, do our clients want a product like this? So the answer to all those questions was yes. Fast forward to today, I would argue AI is no different. It's going to be a huge market opportunity, $7 trillion of CapEx, as Brian, you mentioned. Secondly, we have a track record. We've been doing it for a long time. Today, our artificial intelligence infrastructure business is $150 billion. And third, we have interest from our clients. So when you pull it all together, yes, it's been a challenging endeavor over the last 18 months, but having precedence helps, and we're really excited how we can scale this to the next level.
And Chloe, I guess for Siko, the challenge here is convincing our existing investors this is a new strategy and investing in it. You had a whole different challenge, which is that there was a slide up there that in 2020 we had 0 private wealth clients, and today we have 60,000. So you really had to go out and really establish our brand in that market. Can you talk a little bit about what we've learned over the last couple of years in that channel, and really what's allowed you to be so successful so quickly which is really a first-time fund?
Yeah, thanks, Brian, and good afternoon, everyone. I think for BII, it's really our platform. Brookfield is the preeminent infrastructure manager. We heard it from Hadley. We start with the expertise with the flagship. We are, the best at what we do. We have the longest history. We have the most number of strategies. We have the most consistent track records. We have the deepest operational knowledge out there. And that, for BII, is particularly important because we are really investing across the whole Brookfield infrastructure platform, really the best of Brookfield. And we're creating a comprehensive infrastructure portfolio across our platform for private wealth. As you mentioned, the AI fund and Sikander is creating a new fund strategy from deal deployment. We are doing it from the investor side. We are taking our platform and we're putting it in a wrapper or in a fund structure that we think is attractive for private wealth. So lower minimums, monthly subscriptions with immediate access to the investments or the assets held in the fund, monthly distributions, the yield component this set of investors likes, all with underlying benefits of infrastructure. So we look for downside protection in our assets, that cash yield, the stable cash flows, inflation linkage. So they get a bit of everything there, and it's been a good ride.
And like obviously one of the big challenges with private wealth is shelf space, right? Getting in front of these advisors and their clients and getting the retention. We're not the only infrastructure fund in the private wealth channel. Can you maybe just touch on a little bit about how we differentiate our vehicle and our platform from maybe some of the competitors?
Of course. Our name, our brand, it really comes down to that, to open doors. It does open doors. People want to hear from us in the infrastructure space. But when we're talking to financial advisors and investors, it's really interesting to hear the complementary nature between what they're looking for and what we offer and how we invest and how we do business. Individuals are looking for, from an infrastructure allocation, are looking for a product that's going to add resilience to their portfolios. They've seen the traditional 60-40 mix wasn't as diversified as they thought over the last few years with things moving in the same direction. They're looking for that diversifier, that core allocation that can add, again, that resilience in their portfolio. And that's how we approach investing. We look for the highest quality infrastructure assets out there with long-term contracted or regulated revenues, with investment-grade counterparties, providing that stability. And then we do simple things around the edges to add a bit of return. So this is our bread and butter. It's that operational value add that we do day in, day out, recapitalizing a balance sheet, extending a contract, improving supply chains. Again, things that are in our nature to do. So once we have the product and the platform, we need to sell it. And that's another differentiating factor that's really led to our success. We partnered with Brookfield Oaktree Wealth Solutions, which is our distribution platform for private wealth. So I've worked with them for a few years now, 150 strong sales force globally. They are amazing. They're knowledgeable. They want to learn more. They really believe our products are going to add value and create better outcomes for individuals. And so they're out there pushing our message and doing a phenomenal job getting it out there.
And that's really going to be the key to, again, there was another slide up there about the 401k market and some of the changes that are coming there. But I think you guys have laid the groundwork with getting the brand in there, but that Bose channel is really the key to unlocking that 401k.
It's off the back of the great work that Chloe and the infrastructure team have done, that your team have done in real estate, in accessing retail wealth channels that have allowed us in private equity to actually build a product now that we're really excited about for the wealth channel, that we're able to launch, something that probably a year ago we would not have been able to do. So it's that kind of capability that we have in-house that gets shared across the platform that really helps.
Right.
Yeah, and Brian, I would say the reason why the AI program, infrastructure program, is differentiated is because it's not a data center fund, which are usually greenfield in nature. So there's no yield for investors in the first few years. Half of our program will be capital partnerships with some of the best tech firms and governments in the world. Those are usually yielding investments with a very strong overall risk-adjusted return. That would be a pretty good fit for the BII product.
Yep, we're looking forward to it.
Right. Yeah, and while we're not highlighting a real estate fund in this discussion, that's exactly how the private wealth product that we already have launched for real estate works as well, which is co-investing in our global opportunistic fund as well. And so what's really unique about all this is you're giving access to these private wealth investors who don't typically have access to these types of deals in a wrapper that makes sense for them. And I think that's been a huge game changer.
So complementary to the platform.
Right. Okay, so Siko, let's talk about deals though. That's what everybody wants to hear about. But there's obviously been explosive growth. We talked a little bit about the demand and how we see it. But I would say every conversation that I have with anybody about data centers, they say, yeah, but what if this gets overbuilt? Like, are we not just running off a cliff here? Like, how do you think about balancing those two things, that there is this tremendous demand out there, but not to get too far ahead of ourselves?
Yeah, no, Brian, so has anyone heard the word data centers or artificial intelligence in the last 2 years? I've been around the data center industry for 10 years, which is a century in the tech and the AI world. And I think about it a lot, and obviously I talk about it a lot to a point where my 5-year-old daughter thinks that every warehouse in the UK or Europe for that matter is a data center. And I obviously correct her and tell her it's not a data center, it's an AI factory. And 10 years ago in our business, I just want to give you some context. In our business, we used to do victory laps around the office if we signed a 5-megawatt contract with a customer. Today, some of the younger guys on the floor don't want to get out of bed for less than a 1-gigawatt deal. But there's a reason for that. And the reason is, if you take the US as an example, this year, the US market will add 10 gigawatts of leased capacity. That's unprecedented. The vacancy rates in the US data center market are less than 2.5%, also unprecedented. And lastly, I would say if you watched Oracle results last night, or if you watched the White House tech dinner from a week ago, the amount of dollars expected to be invested in the US alone might actually be underestimated already. So obviously the point is, the dollars are huge, and there's naturally concerns that are we going to have overbuild similar to the 1840s when the rail build-out in the UK led to $25 billion of bankruptcies in today's dollars. And between 1995 to 2001, we had the dot-com bubble that led to a lot of casualties in the fiber space. So investors, and I guess everyone at Brookfield is rightly thinking about, is this a bubble? The counter to that is 3 things. First is, we've had unprecedented growth or demand in our renewable power business and our data center business in the last 2 years, but we've not invested any capital on a speculative basis. We have incredibly strong counterparties on the other side of the contract and long duration contracts, 20 years plus. So that gives us the comfort that our capital is protected and is invested to serve some of the most credible companies in the world. So that's the first point. The second point I would make is the early results of the technology, the early results from the tech firms are quite strong. You can read the reports this morning from what Oracle reported last night. Microsoft 2 weeks ago reported a 20% jump in its Azure revenues thanks to incorporation of the AI product. And similarly, Meta reported a 20% jump thanks to AI. So my point is, we'll have to watch this carefully, but early signs are positive. And lastly, it's a bit of a technical point. I do want to draw parallels to the fiber casualties. Fiber, by definition, has unlimited capacity. That's not the case with data centers. There's a shortage. There's a demand-supply shortage at the moment. So anyways, Brian, so summary is, yes, it is right to be thinking about some of the casualties and overbuild infrastructure capital overshooting itself, but there's signs that there's lots of mitigants in place which give us the confidence.
Yeah, and we often talk about how there's complementary overlap between the different platforms, but when I think of AI and data centers in particular, like that's one area where in a lot of our other ones we think we can invest better because of that sharing, but here it's almost necessary, right? Like your constraint on AI is power and particularly renewable power. You need the land, et cetera. Like maybe just talk a little bit about how some of the things we're doing in AI does not actually neatly fit into just one of the silos, but really is cutting across the whole firm.
Yeah, I think absolutely. So the way I think about this is I use this brain and body analogy. Tech firms are building the brain, and infrastructure investors build the body. The brain cannot think or function without the body. It cannot communicate. It cannot listen. It cannot process. And what is the body, right? What's the definition of this body? It's AI infrastructure. It's land, to Brian's point. It's land, it's power, it's data centers, and it's the chips, and of course the capital. So in our business, individually, whether it's real estate or renewable power or data centers or infrastructure, we have world-class businesses. And the point is we want to bring it all together. So I want to contextualize that with an example. In north of France, our real estate business owns a very large industrial site. It's got hundreds of acres of land. It's got 100 megawatts of power. And we've worked with our renewable power colleagues to figure out a way to scale that power from 100 megawatts to 1 gigawatt. We see there's a path in doing so. And on the technical side, this particular location is located within 2 to 5 millisecond latency between Amsterdam, Frankfurt, London, and Paris. And those are the largest data center markets in Europe. So what have we done with that? Coming back to Brian's question, we've taken that land plot, that package, to the French government and the European Union, who are very keen to work on a sovereign AI project with us. And if they're picking us because we've got those assets and we have a program that we can fund. So hopefully that example helps contextualize why we believe we are extremely well positioned to be a big, big player in the AI space.
Okay, and Chloe, like Connor talked a little bit about how we use the flagship funds to spin out strategies. Your strategy is very much that, where we're touching on it, but you're not doing every deal in every single fund. So maybe just talk a little bit about how we're utilizing the platform and then how that's a real differentiator for BII.
Yeah, so I think at Brookfield, we have a really good track record of growing platforms, launching more strategies. BII is in a very fortunate position where the investor base is so immense, and private wealth has very little allocation to alts today, and the growth could be immense there, but we need deal flow to pair with it. So as you say, it's very important we have the platform to invest alongside and keep growing. And we will build in new strategies like the AI fund into where we can deploy within BII, as we, again, will be the best of Brookfield infrastructure across the whole platform. But I think it's important to note that Brookfield, we've been doing this for years, this innovation, this growth. If we just look at infrastructure, we're not doing anything new with these new funds. We look at deal deployment that we don't have a pool of capital for, or investors that are looking for something a little bit different from what we offer today, and we pair the two together like Sikander spoke about. So within infrastructure, we started with the flagship fund, Brookfield Infrastructure Fund, about 15 years ago. It gave us that credibility Hadley spoke about in this space, that knowledge, that deep operational know-how, and that presence in the market. And then we saw an opportunity a few years later from the deal side where, as we were talking to infrastructure owners and operators, not all of them wanted to sell equity, but almost all of them needed capital to grow their businesses. And so we launched the infrastructure credit strategy, now the largest infra credit strategy in the world. So that was deal driven. And then on the investor side, investors wanted something a little lower risk return, more bond-like cash flows. So we launched our Supercore Infrastructure Fund, a perpetual institutional offering. And then a few years later, back on the deal side, transition. So our presence in renewable power was so strong, we saw that adjacent strategy in transition, and we took the opportunity to launch that, which is now the largest transition strategy in the world. Sikander said, as we said, we saw the deal flow as well, the AI fund, which BII can invest alongside as well. So again, on the deal side, and BII does it all. So it's just so important that we have that all wrapped up for us and that deal flow coming in, so we can raise, all that great capital out there.
Right. Okay, so Anuj, your group does a fair bit across all the various platforms as well. Like maybe just with a couple of minutes we got left here, just touch a little bit on a couple of examples of where private equity, similar to what Siko described on AI, has sort of touched across the platforms.
Yeah, look, we're a huge beneficiary of the overall Brookfield ecosystem and all of our platforms. Many of the businesses we've acquired, we've been able to learn a lot from our colleagues on the end markets or the actual underlying business model. So Westinghouse is an example, the obvious leader in nuclear services. If it wasn't for our presence in renewable power being the largest in the world, we wouldn't have fully understood that there was no transition without nuclear. We were able to underwrite those assets on a plant-by-plant basis and really predict those cash flows with a whole lot of accuracy. If it wasn't for real estate, I don't think we would have had a good understanding of the Canadian or the Australian housing end markets to be able to underwrite First National, which we did very recently, or Latrobe, which we did a few years ago in Australia, or Sagen, the mortgage insurance provider that we own also in Canada. And on the infrastructure side, an acquisition we made in January of this year is a company called Chemolex, which provides heat tracing equipment that is used for pipes or other types of infrastructure utility type assets to keep what moves within the pipe at a precise temperature. If it wasn't for our infrastructure colleagues who educated us on how the mission critical nature of this end product and service, we probably wouldn't have been able to surface value there either. So I'd say we having the broader platform, having the insights and the data and the knowledge from across the Brookfield ecosystem, it allows us to act with conviction and often invest and find value where others don't see it.
Okay, great. So we have 3 minutes left. There's 3 of you, and you have a room full of investors. So I'll give you each 60 seconds to make your elevator pitch on your strategy, and just really sort of highlight, what the opportunity is for investors in each, and what you want to leave people with. So Chloe, maybe we'll start with you.
I'm hoping I don't need my 60 seconds. I've already sold you all, but for us, it has to be the platform. For BII, it's so important. Over 125 years, we've built a platform with global scale and reach. It allows us to be flexible. We can look for the best risk-adjusted returns around the world. You pair that with our operational value add, our expertise, and it's an incredibly powerful combination, and BII gets the benefit of all of it.
Okay. Anuj.
So the proof is in the pudding. Of all the listed asset managers, we have the best private equity track record, period. And if that interests you, I have subscription forms with me, and we're happy to take orders.
That was a good one. It's going to be hard to beat that. I'll go back to my brain and body analogy. Tech firms are building the brain. They need partners who can build the body. And I would say in the last 3 years, 2 things have changed. One, the AI race is not only between China and the US alone. Every Western nation and select Asian economies want to participate in it. So that's changed the dynamic a little bit. Second is the race is also between the tech firms themselves. And so therefore, and the pace of technological innovation is exponentially increasing literally on a monthly basis. So what that means is 3 years ago, the tech firms, whilst they're building the brain, they could pick different stakeholders to build a body for them, assemble it, fund it. Now they're looking for one partner. And as we talked about earlier, we believe given the strength of our platform and given the various ingredients of the body that the tech firms need, we're really well positioned to capitalize on what is quite topical at the moment.
Great. So hopefully that gave all of you a little more color for some of the various strategies and the different channels that we're pursuing to drive some of our growth. So thank you very much for your time.